Hey, what's up everyone? Welcome back to Money Root, where we break down big financial shifts and what they actually mean for your wallet. Today's story is a big one. I want you to imagine this. It's mid-2025. You're sitting in your favorite spot. Maybe it's your couch, maybe your car, or your desk at work, and breaking news flashes on your screen. The U.S. Federal Reserve cuts interest rates. Again. Not once, but twice. It's official. 2 interest rate cuts expected this year. Now, that may sound like technical economic mumbo-jumbo, right? But hold up. What if I told you that those 2 cuts could be the reason you finally buy your dream home? Or finally get your credit card debt under control? This isn't just some Wall Street headline. This is real money stuff. And today, I'm going to tell you a story. A story of how one decision from the most powerful financial body in the U.S. could trigger a ripple effect that touches your loans, your savings, your job, your goals, and yes, your future. So sit back, relax, and don't click away. Because by the end of this video, you'll not only understand what the Fed's doing, you'll know exactly what you should be doing next. Let's rewind for a moment. Picture the economy like a massive machine. Over the past few years, this machine has been running hot. Prices shooting up, interest rates rising fast, people struggling to keep up. The Fed responded by tightening things. Higher interest rates were like slamming the brakes on a speeding car. And it worked, kind of. Inflation cooled down, but so did everything else. Borrowing slowed, home buying slowed, business investment slowed. Fast forward to now, mid-2025. The economy is showing signs of strain. Growth is weakening, job numbers are starting to slip, and consumer spending, once the engine of American prosperity, is down. Enter the Federal Reserve with a new plan. Cut interest rates twice this year. The idea: stimulate the economy, make money cheaper to borrow, get businesses and individuals spending again. Sounds good, right? But as always, the devil is in the details. Let me introduce you to someone. Her name's Erica. She's 34, a marketing manager living in Austin, Texas. Erica's been renting for almost a decade, dreaming of owning her own place. She's got a good job, a solid credit score, but rising mortgage rates in 2023 and 2024 crushed her hopes. Every time she ran the numbers, the monthly payment on even a modest home was just too high. But then came the whispers. Early 2025, economists began predicting that the Fed might pivot. Rates could drop. By spring, it became more than speculation. It was strategy. And that's when Erica did something smart. She paused. She didn't jump into a high-rate mortgage just because she was tired of renting. She waited. And now, with 2 rate cuts on the horizon, her patience could finally pay off. Now let's break this down. How exactly do Fed rate cuts affect people like Erica? Or like you? Here's the chain reaction. The Fed lowers its benchmark interest rate. This is the rate banks use to lend to each other. That, in turn, affects everything from mortgage rates to auto loans, student loans, and credit card APRs. When borrowing becomes cheaper, more people borrow. More people buy. The economy gets a shot of adrenaline. Let's use real numbers here. Say you are planning to buy a home at a 7% interest rate. On a $300,000 mortgage, that's about $2,000 a month in principal and interest. But if rates drop to 6%, just 1 percentage point lower, that same loan might cost you $1,800. That's $200 saved every single month. Over 30 years, that's over $70,000. That's not pocket change. That's life-changing money. So when the Fed cuts rates, borrowers win, right? Not so fast. Now, let me tell you about Jonathan. He's 62, recently retired, and has most of his savings in a high-yield savings account and a few CDs that started earning a decent return when interest rates were higher. For folks like Jonathan, those juicy 4% to 5% savings account yields were finally a blessing after years of low returns. But when the Fed cuts rates, those savings rates go down too. Suddenly, the bank that was paying you 4.5% drops it to 3.5% or lower. Over time, that's less interest income. For retirees or conservative savers, that's a hit to their bottom line. So while borrowers celebrate, savers brace for tighter returns. It's a classic trade-off. The Fed doesn't set savings account rates directly, but the ripple hits fast and hard. It's like watching a seesaw. When rates go down, borrowers rise, but savers dip. But let's not forget the entrepreneurs. Take Chris, who owns a small but growing e-commerce business. He's been eyeing an expansion, new warehouse, bigger team, and maybe even international shipping. But the cost of financing held him back. Bank loans had 9% interest rates in 2024. For a small business, that's a heavy load. Now, with the Fed's rate cuts expected, banks may start offering loans at lower rates, maybe 7%, maybe even 6%. Suddenly, expansion looks more feasible. Lower capital costs could mean more hiring, more sales, and more growth. But again, there's a twist. If the Fed cuts rates because it fears a slowdown, then demand might shrink. People might borrow more, but spend less. Businesses might expand into a weaker economy. That's the tightrope. Smart business owners like Chris know to balance ambition with caution. Let me give you a real-world snapshot of what's happening right now. According to data from early 2025, small business loan applications have already seen a 6% uptick just from the anticipation of rate cuts. Why? Because business owners are planning ahead. They're trying to lock in lower rates before the economy responds in full swing. But here's where it gets interesting. Some businesses are playing defense, not offense. Meet Rachel. She runs a boutique hotel in North Carolina. When interest rates were high, she didn't dare take on new debt. But she also knew her competitors were pulling back too. Now that cuts are coming, she's considering a renovation loan to revamp her hotel rooms, add a rooftop bar, and boost online bookings. Why now? Because she understands timing. She knows that when interest rates drop, demand eventually rises. Travelers spend more. Couples plan weddings. Events return. Rachel's bet isn't just on lower financing, it's on a post-cut recovery boom. And that's a savvy move. So what does this mean for you? Whether you run a small business or you're working a 9-to-5 and considering a side hustle, moments like this are windows of opportunity. When money gets cheaper, movement starts. The bold find ways to leverage that movement for growth without overextending themselves. All right, now let's bring this back to you, because understanding what's happening is one thing. Knowing how to respond, that's where the real money is. So here are 5 things you should start thinking about today. 1. Revisit your debt strategy. If you've got high interest debt, credit cards, personal loans, start planning your attack. As rates go down, balance transfer offers get better. You might be able to consolidate or refinance and save thousands in interest. 2. Prepare to refinance. If you've got a mortgage or auto loan, don't just sit on it. Start researching refinance options now. When the cuts hit, rates may dip, but demand will spike. Banks will be flooded. Get ahead of the wave. 3. Time. Big purchases. Carefully thinking about buying a car or a house. Wait for the rate cuts to take full effect, but not too long. The sweet spot is often shortly after a Fed cut, before the market adjusts and prices rise due to increased demand. 4. Review your savings plan. If you rely heavily on interest income, start looking at alternative savings strategies. Maybe dividend-paying stocks, short-term bond funds, or laddered CDs that help you lock in better rates. 5. Don't forget the stock market. Historically, lower rates can boost the stock market, at least in the short term. Investors chase yield, companies borrow more cheaply, and stock prices often rise. That said, if the rate cuts are tied to a weakening economy, volatility could spike. Play it smart. Don't chase hype. Diversify. Here's something you won't hear in most mainstream coverage. These Fed decisions don't happen in a vacuum. Behind every rate cut is a storm of data, speculation, and sometimes panic. If the Fed cuts too slowly, inflation might return too quickly, and we might hit a recession. Timing is everything. But here's the key. Don't let macro events dictate your entire financial strategy. Use them as a signal, not a command. Rate cuts are opportunities, but only if you're ready for them. So, there it is. 2 rate cuts. One big opportunity. But it's not just about what the Fed does. It's about what you do next. If you're a borrower, get ready to pounce. If you're a saver, start adjusting. If you're a business owner, balance your excitement with strategy. And if you're just starting your financial journey, use this moment to learn, to plan, and to move forward smarter than ever before. Because when the Fed speaks, the world listens. But it's up to you to act. If you found this breakdown helpful, make sure to hit that like button, subscribe to Money Route, and drop a comment below. How are you preparing for the rate cuts? Are you refinancing, saving, investing? I want to hear your stories. Thanks for watching, and I'll catch you in the next video. Stay smart, stay sharp, and as always, follow the money.